We used to have programs like 0 downs, 5% downs, cash back mortgages. Anybody could get a mortgage back in the day. Today it's more difficult. What's up, YouTube? There's been some conspiracy, and I want to solve this conspiracy in today's video. And that conspiracy theory is that we're sitting in the midst of another 2008 market crash where the stock market, the real estate market went boom, the biggest crash since the Great Depression. Is that gonna happen? Well, watch this video and find out. I will be covering all of that, and I will give you my predictions on why or why not that may happen. So if you want value and you want some real estate knowledge, hit that subscribe button so I can keep these videos rolling. All right, let's figure out what happened in the 2008 market. So in the 2008 crash, there were some issues that started back in 1999. In 1999, lenders in the US were really focusing on, or started focusing on, subprime borrowers. What are subprime borrowers? Subprime borrowers are people, let's call a spade, that should not be owning real estate. They're low credit and they're very high chance of defaulting on a mortgage. So if you had a heartbeat and willing to have a mortgage, US sponsored lenders like Freddie Mac and Fannie Mae would give these loans to subprime borrowers. These subprime borrowers actually had lower monthly payments in the beginning of these loans, but these monthly payments went higher over time. So after a few years, their payments would be high. That's a recipe for disaster, isn't it? I don't know why I wasn't there in that board. I could have told them that. So now what these financial firms did, they sold these subprime mortgages, they pooled them together, they sold them to investors as mortgage-backed securities. So here are people that shouldn't have a house, are getting homes. I bet you mortgage brokers made a lot of money back then, but they're getting homes that are not supposed to have homes. These financial firms pooled all these bad mortgages together, sold them to investors. Guess what? They just started defaulting. And that led to the subprime mortgage crash in 2008 in the USA. So let's fast forward time and let's talk about today's hot market compared to the market in 2008, which was hot. Like before it crashed, it was booming hot. Houses were selling overpriced, over asking, like you saw in today's market as of recent times. So people are thinking there's a similarity there. That's why I want to take the time and explain the actual facts of why that market crashed in 2008 and why I don't see a crash coming up. So the difference here today is, yes, houses are going and selling way over asking price. People are thinking there's going to be a bubble that's going to pop. However, there's a big difference on lending and mortgages today. We learned from the 2008 experience. We have something called a stress test. That stress test, even though the mortgages were low, we are getting qualified at way higher rates. We're getting qualified. Today's Bank of Canada rate is 5.25. And a lot of banks, they are adding 2% to the contracted rate that they're giving the end user. So if they're getting a mortgage of 3.5%, they're getting qualified at 3.5% plus 2%, which is 5.5%. So what the stress test is actually saying, which has been around since 2018, by the way, this is not recent. What the stress test is basically screaming to consumers is, yes, we will give you a mortgage at lower interest rates, only if you can qualify at the higher interest rates. So the powers to be were smart enough to understand that these interest rates will eventually rise. So they weren't giving people mortgages that didn't deserve it. For someone that's been in the business for 17 years now, I see the difference in qualifying. We used to have programs like 0 downs, 5% downs, cash back mortgages. Anybody could get a mortgage back in the day. Today it's more difficult. You have to qualify as the stress test. You have to, whether it's insured or uninsured mortgage, by the way, okay? I did do a video on breaking down mortgages in the past, and I will do more, so make sure you hit that subscribe button. So let's get back to the video. So the question then is, why is house prices skyrocketing in recent times if it's harder to get a mortgage? That's a good question, so let me explain it. The reason is we have more purchasing power as consumers. Let me explain. First of all, we've been in a stimulus society since the 2008 crash, pretty much. Because since 2008 crash, interest rates had to stay low. The economy eventually picked back up. In Canada, where I'm from, we didn't really feel this crash. We didn't have this crash. We just had a period of this consumer confidence. What we did, we just banked on these low US interest rates because Canadian interest rates and US interest rates have to be very similar. They're our biggest trading partner. So because of the interest rates being similar, the US was in a stimulus economy where interest rates had to be low, therefore our interest rates were low. Because interest rates were low, people were safe, buying real estate, and people became really house rich. Since 2008, their prices of their home have doubled, tripled, quadrupled in some areas. So they have a lot of money in their home. We have a little saying in the GTA where I'm from, the Greater Toronto area, everybody's a millionaire because they have so much equity in their home. So long as you owned real estate, you have a lot of equity in your home. Put that in the bank, okay? Now, because of the pandemic, there was also more purchasing power. People didn't travel, they didn't go out to restaurants, they couldn't. So they banked that money. A lot of workers still had jobs, okay? They still had jobs. Zoom, they were working from home and zoom, 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 and a boom, boom. That's all they were doing, day in and day out. The government also came up with a couple of stimulus packages like mortgage deferral. So now these people are house rich, they have more purchasing power because they still have jobs, and now they don't have to pay their mortgage, okay? Other people that have lost their jobs, at least they don't have to pay their mortgage, and we had something called CERB here, where the government would actually pay you a percentage of your salary just to stay home. There was all kinds of programs, that's not this video. However, the purchasing power was higher, and real estate is a safe asset to invest in. So people had more purchasing power, interest rates were low, they bought real estate. Either they would buy investment properties with their line of credits, and they had more down payments to put down. They met that stress test criteria. So by meeting that criteria, the economy is safe. What we're experiencing right now is a lack of consumer confidence. I covered that already in a previous video. How long that lasts for, I don't know. However, at least in my marketplace, I feel that this is a totally different situation than there was in 2008. I have a question for you though, and I don't know the answer. How many consumers that were buying real estate found a loophole in getting their mortgage by meeting their stress test? That could be another subprime market, because there's a lot of people that are qualifying for mortgages that shouldn't be getting them. There's a lot of creative characters out there that are getting that done, which I don't agree with, but I feel like that is a low percentage. If I'm wrong with that, and that's actually a big percentage, we can see some bigger correction. So I say we're in a correction and not a crash. Guys, if you enjoyed this video, you know what to do. Smash that subscribe button. Love giving you guys some value. Hopefully you got some today.